The double bottom pattern is a bullish reversal pattern often used in technical analysis to identify potential trend reversals in financial markets. It resembles the letter W and indicates that the price of an asset is finding support at a particular level, forming two distinct lows, the bottoms, before moving higher. Key characteristics of a double bottom. First bottom. The price declines to a support level, marking the first low. This low is usually followed by a rebound as buyers step in, pushing the price higher. Second bottom. After the rebound, the price falls again, approaching the same support level as the first bottom but does not significantly break below it. This forms the second low, signaling that the support level is holding firm. Neckline. The peak between the two bottoms is called the neckline. This is a critical level because the pattern is confirmed when the price breaks above this level after forming the second bottom. Breakout. A breakout above the neckline indicates a reversal of the previous downtrend and is considered a bullish signal. Traders often enter long positions at this point, expecting the price to continue rising. Volume confirmation. Volume can play a crucial role in confirming the validity of a double bottom pattern. An increase in volume during the breakout above the neckline suggests stronger buying interest, increasing the likelihood of a sustained upward move. Trading the double bottom. Entry point. Traders typically enter a long position when the price breaks above the neckline. Some may choose to wait for a retest of the neckline after the breakout to confirm the pattern's validity. Stop loss placement. A stop loss is often placed just below the second bottom to protect against a potential false breakout. This helps limit losses if the price unexpectedly reverses downward. Profit target. The profit target can be estimated by measuring the distance between the bottoms and the neckline and projecting that distance upwards from the breakout point. This method provides a target price where the trader might consider exiting the trade. Risk management. As with any trading strategy, risk management is crucial. Traders should carefully assess the potential risk-to-reward ratio before entering a trade and adjust their position size accordingly. Example of a double bottom in practice. Suppose a stock is in a downtrend and reaches a low of $50 before bouncing back to $55. The stock then declines again to around $50, forming the second bottom. If the price rises and breaks above $55, the neckline, this would confirm the double bottom pattern. A trader might enter a long position at $56, place a stop loss at $49, and set a profit target based on the pattern's height. Considerations and limitations. False breakouts. Not all double bottoms lead to a successful reversal. Sometimes the price might break above the neckline but fail to sustain the upward momentum, leading to a false breakout. Therefore, it's essential to use additional indicators or wait for confirmation before taking a trade. Market conditions. The effectiveness of the double bottom pattern can vary depending on overall market conditions. In a strong downtrend, even a well-formed double bottom might struggle to reverse the trend. Time frame. Double bottoms can appear on various time frames, from intraday charts to long-term weekly or monthly charts. The reliability and significance of the pattern may vary based on the time frame used. The double bottom pattern is a valuable tool for traders looking to identify potential reversals in a downtrend. While it can be a powerful indicator, it's essential to combine it with other technical analysis tools and sound risk management practices to increase the chances of a successful trade. A false breakout occurs when the price of an asset appears to move beyond a significant level of support or resistance, signaling a potential continuation in the direction of the breakout. B. A double top is a bearish reversal pattern commonly used in technical analysis to signal a potential change in the direction of an asset's price trend. It indicates that the price is struggling to break above a certain level and may soon start to decline. The pattern resembles the letter M and is considered the opposite of the double bottom pattern. Key characteristics of a double top. First peak. The price of an asset rises to a resistance level, forming the first peak. This is usually followed by a pullback as selling pressure increases, causing the price to decline. Second peak. After the pullback, the price attempts to rise again, approaching the same resistance level as the first peak. However, it fails to break above this level, forming the second peak. This inability to surpass the previous high suggests that the uptrend is weakening. Neckline. The lowest point between the two peaks is called the neckline. This is a critical level because the pattern is confirmed when the price breaks below this level after forming the second peak. Breakdown. A breakdown below the neckline signals a bearish reversal, indicating that the previous uptrend is likely over, and the price may continue to decline. Traders often enter short positions at this point, anticipating further downward movement. Volume confirmation. An increase in volume during the breakdown below the neckline strengthens the validity of the double top pattern. Higher volume indicates stronger selling pressure and a greater likelihood of a sustained downtrend. Trading the double top. Entry point. Traders typically enter a short position when the price breaks below the neckline. Some may wait for a retest of the neckline after the breakdown to confirm the pattern before entering the trade. Stop loss placement. A stop loss is often placed just above the second peak to protect against a potential false breakdown. This helps limit losses if the price unexpectedly reverses upward. Profit target. The profit target can be estimated by measuring the distance between the peaks and the neckline and projecting that distance downward from the breakdown point. This gives an indication of where the price might move following the breakdown. Risk management. As with any trading strategy, risk management is essential. Traders should carefully assess the potential risk-to-reward ratio before entering a trade and adjust their position size accordingly. Example of a double top in practice. Imagine a stock is in an uptrend and reaches a high of $120, forming the first peak. The price then pulls back to $115 before rising again to $120, forming the second peak. If the price then falls and breaks below $115, the neckline, this would confirm the double top pattern. A trader might enter a short position at $114, place a stop loss at $121, and set a profit target based on the pattern's height. Considerations and limitations. False breakdowns. Not all double tops lead to a successful reversal. Sometimes the price might break below the neckline but fail to sustain the downward momentum, leading to a false breakdown. It's essential to use additional indicators or wait for confirmation before taking a trade. Market conditions. The effectiveness of the double top pattern can vary depending on overall market conditions. In a strong uptrend, even a well-formed double top might struggle to reverse the trend. Time frame. Double tops can appear on various time frames, from intraday charts to long-term weekly or monthly charts. The reliability and significance of the pattern may vary based on the time frame used. Double top in different market contexts. Stocks. In the stock market, a double top can indicate that investors are losing confidence in the stock's ability to rise further. It often occurs after a significant rally, suggesting that the stock may be overvalued or facing headwinds. Forex. In currency trading, a double top might reflect a shift in sentiment regarding a particular currency pair. The head and shoulders pattern is one of the most well-known and reliable chart patterns in technical analysis used to predict trend reversals. It can signal both bullish to bearish, standard head and shoulders, and bearish to bullish, inverse head and shoulders, reversals. This pattern is named for its distinct appearance, which resembles a head between two shoulders. Standard head and shoulders pattern. Key characteristics. Left shoulder. The price rises to a peak and then declines, forming the left shoulder. This peak occurs after an uptrend, and the subsequent decline indicates the beginning of weakening momentum. Head. After forming the left shoulder, the price rises again, reaching a higher peak than the first one, forming the head. This is followed by another decline, typically to the level of the previous low. Right shoulder. The price rises once more, but this time it fails to reach the height of the head, forming the right shoulder. The subsequent decline back to the level of the previous lows completes the pattern. Neckline. The lows of the pattern, typically connecting the bottom of the left shoulder, head, and right shoulder, form the neckline. This is a crucial level because the pattern is confirmed when the price breaks below the neckline. Breakdown. A break below the neckline indicates a bearish reversal, suggesting that the uptrend is over and a new downtrend may begin. Traders often enter short positions at this point. Volume consideration. Volume typically increases during the formation of the head and decreases during the formation of the right shoulder. When the price breaks below the neckline, a significant increase in volume strengthens the bearish signal. Trading the standard head and shoulders. Entry point. Traders typically enter a short position when the price breaks below the neckline. Some may wait for a retest of the neckline after the breakdown to confirm the pattern before entering the trade. Stop loss placement.